Welcome back to another Reddit reading. This one was posted by user Chris962X on subreddit GME, titled Explained for Total GME Reddit Stonk Noobs Why the GME Short Squeeze is Not a Conspiracy Theory Even Though Ignored by Mainstream Media. Are you worried that the GME Short Squeeze thesis is crazy tinfoil hat conspiracy, like a financial QAnon of sorts? Here's a guide for complete GME Reddit noobs that seeks to debunk that worry, with lots of links for helpful data for the skeptical. TLDR, the short answer as to why the GME short squeeze play isn't financial QAnon can be summed up most simply in the following way. Evidence points to 2008 style market fraud and 2008 style cover-up until there is no alternative but market crash. Part of the cause and or fallout is a likely GME short squeeze of a size never seen before, called the MOS around here, or mother of all short squeezes, and unlikely to ever happen again as regulations are being put into place to prevent it. There are solid reasons why the mainstream media, like in 2008, is barely reporting this. See section right below for this. For quick hard data to back up claims, see quick hard data below, and for info on what a short squeeze is, that has its own section below too. The longer version, explained so complete GME stock Reddit noobs can understand it, is below. The big question: why hasn't the mainstream media reported on the real GME situation? The reason is simple. A 2008 style crash is coming. Due to massive securities fraud, and just like 2008, it seems simply unthinkable to many that trusted players would lie to them. Certainly not again. And certainly not on a 2008 style scale. This is despite the fact that there's a massive incentive to do so, and as will become clear below, some of this happens quite often on a small scale and everyone just looks the other way. But now, what a surprise, someone got super greedy and did it on a massive scale, and the gig is up, but nobody wants to admit to it until there's no alternative. Now, it is likely the big players know this 2008 style crash is coming, and they want to avoid panic before all the safeguards are in place for a controlled detonation of a toxic partner who will be positioned as the lone bad apple that causes the crash. Because if panic happens beforehand, the crash could get out of control. So mainstream media, which doesn't really understand the markets, especially in their more recent form, algorithmic high-frequency trading, AI, data mining, virtual shares, and various derivative instruments, is fed info by their contacts, and sometimes owners, to manage expectations until everything is ready. A lot of this has to do with the fact that markets and their reporting are built on trust, at least until players reveal they aren't trustworthy, and then so many people are shocked even though they shouldn't be. But we've seen this movie before, literally. In 2008, everyone believed that Moody's bond ratings were to be trusted. See here. But Dr. Michael Burry and friends did their homework to show that Moody's hadn't, and the reason is Moody's trusted what they were told, which turned out to be fraudulent in relation to subprime mortgages and the mortgage-backed securities upon which the repo market was based, meaning that the value of all this collateral was crap, leading to a confidence and liquidity crisis and government bailout. Mainstream media was saying Lehman is solid until it wasn't, and buy Bear Stearns until it declared bankruptcy. Something similar is happening right here, because if you start to check the numbers backing up the official numbers, all publicly available, the official numbers don't add up. And there's only a small handful of ways to explain that, all of which point to massive securities fraud due to naked shorting, a practice the SEC has said could destabilize the market, but has only tried to limit in the most slap-on-the-wrist kind of way. Today, the situation is similar to 2008. The only difference is the big players likely see it coming. Huge bond sales, repo market, crypto dump. And the regulatory agencies are filing regulations at a fever pace to protect as much of their asses as possible and to keep the detonation of today's Lehmans and AIGs from truly collapsing near everything. Keeping this hush-hush until it is too late keeps this manageable for all players, and is in their best interest, but is also easy as few in the mainstream media are likely to imagine their most beloved sources are lying to them and committing fraud. But isn't that exactly what happened in 2008? It sure is. But this time the problem isn't mortgage-backed securities, it's naked shorting. Understanding the GME short squeeze argument. Explained so anyone can understand it. The setup, naked shorting. The practice of naked short selling is a form of systemic corruption in the US stock market today. Most major players, Barclays, Citigroup, Goldman Sachs, etc., have gotten slaps on the wrist for it, but the regulatory agencies self-regulate, via FINRA, with revolving door to the very companies they regulate, like SEC. For more on this, see here, also see here and here. The FINRA data on short selling is self-reported. Errors are often reported years late, and fines are often minimal compared to massive gains, meaning the practice of naked shorting is dirty, open secret in US markets. Technically, naked shorting is securities fraud, and the SEC published a paper on risks of this practice to market as a whole, though they did little to stop it. See the well-sourced Wikipedia page on naked short selling here. One company that has been fined and banned from short selling in various markets due to violations, let's call it Shitty Dell. It's a major player on the New York Stock Exchange with market maker privileges, which including legal limited naked shorting to provide market liquidity in its trades. Now the investment wing of such a company would never abuse that privilege, right? Overplaying their hand. Shitty Dell seems to have taken the naughty practice of naked shorting to the next level, and on a massive scale. Shorting is a bet that a stock price will lower, but when a short position is taken, this leads those who sell the short to hedge their bet by selling some of the stock themselves, having some indirect depressive pressure on the stock price. Shitty Dell seems to have realized that by naked shorting, they could drive brick and mortar companies into the ground, and with quarantine, ramped this up. This is a very expensive practice, but if the gamble works, you never have to pay the shorts back because the company goes bankrupt like what Bain Capital did to Toys R Us. Massive profits. There even seems evidence that Shitty Dell may have naked shorted the repo market itself via 10-year treasury bills, such that GME might not be the only toxic behavior at play, but the one they were most easily caught by. See here for more info. What could go wrong? The well trap. Enter another player, one of Shitty Dell's competitors for market dominance, that would very much like to see Shitty Dell out of the picture. Let's call them Burp Rub, or BR. Let's say they realized what Shitty Dell was likely doing, but like most big player funds, are prevented from taking advantage of this by various regulations that were more likely to be enforced than the naked shorting ones. What BR likely realized, however, was they could set a trap for Shitty Dell. They just needed to find the right situation and the right bait. They couldn't take them down in the open, but they could wait for the right opportunity and let others do it for them, and profit from the results. BR also wanted to get back of Shitty Dell for burning them a while back on a big trade. It's a long story. In the meantime, Shitty Dell turned its naked shorting sell sites on GameStop, figuring it could make a ton of cash, and by bankrupting the company to oblivion, they wouldn't even have to pay for all those naked shorts they borrowed. BR, realizing this, likely saw their opportunity to set the trap, and the rest is history. See, recently, a big fund had helped finance Ryan Cohen to develop his pet food e-commerce company, Chewy, which he had then sold, and what if someone then helped fund Cohen's takeover of GameStop as new CEO? What a nifty trap. Why? Cohen's plan was to remake GameStop into an e-commerce behemoth like an Amazon of digital gaming. For more, see here. And when it was announced he was getting involved, this alone raised share price above the range of Shitty Dell shorts, trapping them. Because they can't get out of these bets ever unless the price goes down below that of their short bet. And what is more, they need to pay interest on these bets over time. Tick-tock. At this point, somehow, I will leave this up to the imagination. People on Reddit started to realize that the most easily available public data on GameStop was messed up, and some basic digging turned up the fact that there were likely more shares shorted than exist, indicating likely naked shorting. This led to the first micro squeeze in January, which got squashed by Robinhood, etc. Since then, Shitty Dill and friends have said they covered their share contracts, but the numbers still don't add up. If one looks at the easiest to find public data, i.e. S3 or Ortex, it reads that they escaped, but those numbers, as mentioned above, are self-reported. See here. There's only a small fine at their level of cash for errors, see prior link. And the formula was recently changed in a way that helped obscure such practices. And most keeping track of these sorts of things hadn't realized this, because it was never a big issue before. Keep in mind just how many trades happen per day. I can imagine it all blurs after a while, and whatever happens for zillions of trades would seem normal for all of them. But with a little digging, Redditors showed that public data that required more rummaging around to find simply didn't add up to what the easy-to-access numbers that mainstream media went by said. What the mainstream sources likely didn't do was what the Redditors did: rummage around, add up all the numbers, look for the numbers behind the numbers, and start asking questions. Like what happened with the Pentagon Papers, or the Panama Papers, or the Big Short. It's hard to explain stuff like this, or this, unless something shady is going on. Now, the logical reason for why the numbers behind the self-reported, easy-to-access numbers didn't add up is that Shitty Dill, which had been reprimanded and even banned in some international markets for doing just this, was in fact hiding their naked shorts by failing to deliver and covering these using various quasi-legal means that are decently hard to track. Stuff with ETFs and synthetic calls, hoping few check the details, waiting for the price to go down again. This thesis is supported by the fact that since the January mini-squeeze, GME price would continually behave strangely, diving but with barely any volume of people selling, which is what normally makes prices drop. What could account for such behavior? Only one sensible thing: more short selling, which, like the rest, was also not reported. As crazy as it sounds, Shitty Dill was likely doubling down, kicking the can down the road in hope of shaking the crazy Reddit crowd. Don't believe me? Believe the numbers at this link. The turnaround. Now, even beyond the squeeze, it's worth saying GME is headed for a very strong e-commerce turnaround. They are rebooting their brick-and-mortar locations as gaming experience centers and have brought on a whole new team of e-commerce heavy hitters with a ton of experience in this realm to help Cohen bring about the transformation. They also just paid off whatever debt could get in the way of making all this happen. Beyond this, it was recently announced that GME was getting into the NFT business, and NFT GameStop tokens would be a smart way to create an entire secondhand digital gaming market, which could be promoted by issuing shareholders a dividend to thank them. But such an NFT dividend could also be a way to snag short sellers, as Overstock did with a crypto dividend when it was overshorted in 2019. NFTs, like crypto, are essentially impossible to forge. Now, if dividends are offered in NFT, only real shares will get those, and counterfeit naked ones won't, which will show what's real and what's not. NFT info link and more. Now, Overstock got sued for doing this, so they had to show a legit reason for doing what they did, namely hard evidence that people had shorted them using counterfeit shares. They did this by having a shareholder vote and showing that there were way more votes than shares, and so Overstock won the court battle and the shorts were squeezed. GameStop is currently holding a shareholder vote for its new board of directors for the June 9th shareholders meeting. TikTok. Overstock short squeeze background info comparison with GME. The movement. Now, all this is unprecedented in the market, if you don't count 2008 at least, which is why Shitty Dill likely figured they could get away with naked short selling like this. They bet that everyday dumb money stock purchasers or retail investors wouldn't be able to get through all their smoke screens to see them fudging, and even if they did, it would take hordes of them buying and not selling as individuals, even when the price was artificially tanked by yet more shorting. And what's the chance? Now, before the internet and social media, this would have been impossible, and even today, it took a while for an online community to start going through the data together. Hiding shorts, using dark pools to hide shorts. But once it happened, it congealed into a movement. So many were burned by 2008, and the regulators were letting it happen again? The GME movement on Reddit left WSB, or Wall Street Bets, as their mods were likely infiltrated by those wanting to scare off short squeezers, with the group landing at subreddit GME and then subreddit Superstonk. From there, crowds of people educated themselves. Wrong data and incoherent hypotheses were scathingly debunked, and the Redditors even evolved a form of peer review and brought in expert witnesses in weekly AMA interviews to gain the insight of those with real old school chops, yet willing to take on the system. It likely helped that some of these Redditors have relevant backgrounds, but each makes their own decisions, and the mantra is, do your own homework, don't believe anyone else, make your own informed decisions. This is why DD, or due diligence, is so valued. Over time, subreddit GME and subreddit Superstonk have evolved into a supportive, tolerant, diverse, and, in my honest opinion, surprisingly nice and compassionate community. This is the internet, after all, with a lot of folks pushing for massive market reform and common reminders to not become like the greedy manipulators you are fighting against that keep crashing the market, hoping for a bailout on the backs of those they ruin. Amen. Now, why did this happen now? Shitty Deal's practices threatened the whole market. They had become toxic to their peers, and the only way to stop them with a toothless SEC was to take a big chunk of the market with it. With BR was happy to do so, because they'd be there to pick up the pieces, cheap, to reap massive profits when market eventually recovered. So, Shitty Deal now spends its final days unable to get out of its short positions, spending gobs of cash delaying and spreading info that the squeeze is over or already happened, in the hopes that everyday investors walk away. But Reddit keeps showing that the numbers indicate that it's all hype. The controlled detonation. The result is that GME is set up to be the MOAS, mother of all short squeezes. Not for any reason really having to do with the stonk's fundamentals at all, though the shift to e-commerce is part of why this all comes together. But mostly because it was how Shitty Deal got caught with their hand way deep in the cookie jar. Keep in mind, there have been short squeezes before, and while every unusual event, when they happen, it's pretty crazy to watch. And this one is so unique that it's going to be once in a lifetime kind of thing, because they won't let this happen again. All evidence seems to point that all this is widely known by the powers that be, who likely want to have this all go down as a controlled detonation on the now toxic Shitty Deal. All the new regs going on the books from DTCC, DTC, NSCC, OCC, ICC, and FINRA are there to make sure that when a big player goes down, the effects are limited as much as possible from impacting what's around it. Shitty Deal will then likely take the fall for the entire market's dirty secret regarding naked shorting, but as it got greedy, there it goes. It's in the best interest of all the big players that this controlled detonation happens. Let's go through the list. BR likely set the trap and will be there to pick up the pieces, with a major competitor eliminated and gain massive profits from market dominance after this. The government takes out a player that was doing stuff that threatened the status quo of the market with its risky practices, with a nice fall guy to be the lone bad apple, so they don't have to go and change much afterwards, though many Redditors hope to create pressure for change afterwards. The government and regulatory agencies will also likely be able to limit the damage to the rest of the economy of a likely unavoidable crash by means of all these regs, so that this crash is far less likely to be bigger than 2008, but more like 2008 light. The government will also make massive taxes from the winnings, which will be like another round of targeted stimulus that is more likely to be spent and stimulate the economy by going to consumers than more traditional government stimuluses that tend to get siphoned off by corporations in various ways. Calculations indicate the cost for the entire squeeze, even at its most massive, would likely be about $5 trillion, not more than the most recent stimulus, and 40% of that would all but immediately return to the Fed via taxes. Shitty Deal knows they're caught, and they get some time to try to wiggle out while the rules are put into place, and maybe even hide some assets offshore. But if they go along nicely once things start, this will likely allow their main players to avoid jail time. And everyday retail investors? We may be pawns of BR's trap for Shitty Deal, and merely going along for the ride, but unlike many market crashes, we will likely be well paid for playing this role. and quite empowered going forward. Some have said the MOAS could be the single largest top-down transfer of wealth in human history. Oops, shitty deal. That ain't supposed to happen. Appendix. But what's a short squeeze? A short squeeze is when all the real shares of a company are recalled, and the counterfeit shares produced by naked shorting need to be paid back from those they were borrowed from. Often, several times over, and a crisis ensues. The shorts need to pay back all the shares they borrowed, and they need real shares to do so. If the owners of the real shares decide to just hold and not sell, the price will keep going up, and shorts will scramble over themselves to sell before the price goes yet higher. The price can go as high as the owners of real shares have patience to hold. Infinity is the limit, on short squeezes in general. Once the price hits certain levels, however, a fund will get margin called. Because it's on paper, debts start to exceed what others think they can pay, and they are required to put up more collateral, and if they can't do this, regulators take control of their assets and liquidate them via computerized automatic auction. From there, it is just watch the price go up to the moon for the sellers, with the hook for whatever price, with their creditors managing the whole process. And if the shorts go bankrupt, their creditors are on the hook. And if they go bankrupt, there's clearinghouses and their insurance. And at last resort, the Fed itself. Now the government could step in and change the rules of the game, but if they did this, the whole world might see the US stock market as untrustworthy, and so to keep the world's business, it is in the interest of the Fed to let this go down. Quick evidence that a market crash is likely coming. Look at the VIX index, used to track likelihood of volatility, hitting record numbers lately of the sort which only tend to occur before a major market event, most frequently a crash. Look at the repo market. I heard it once said that if the stock market is a car, the repo market is the transmission. And when the transmission seizes, like it did in 2008, everything stops. The repo market and its complement, the reverse repo market, is how the Fed adjusts overall market liquidity, providing overnight loans of cash or securities to keep markets and the economy more generally well lubricated and moving. The repo market is also the main way the government puts more money into the economy when it prints it, or pulls money out of the economy to fight inflation. The quantitative easing that the Fed has used since the 2008 crisis to manage the overall state of the economy via money supply has largely occurred through how it works its repo/reverse repo markets. Right now, almost all the funds which could take repo money are doing so. And while there's usually a ton of excess room to adjust things with these markets, the repo market is hitting record levels of use and is nearing its cash ceiling. This signals likely market crash unless something big happens to prevent it. Repo market and GME info. Repo market's link to GME. Various regulatory agencies are filing new regs at an unprecedented pace to limit the fallout from major defaults, likely because they anticipate them. They see something huge coming. The new regulations summarized. Quick evidence, what's going to happen likely will involve a GME short squeeze. GME has a massive and unprecedented negative beta index, an indicator that means it goes up when the market goes down. This very unusual situation likely indicates that a major market player is likely selling oodles of assets to depress the price of GME whenever it goes up. Since the January micro squeeze, GME price dives even if very few are selling and many are actually buying according to volume data. This means that the price depression is due to shorting that is not being reported to normal market channels. Shady shit behind the scenes. Here's a great post on how they do this. FINRA data on GME has tons of FTDs or failures to deliver, even as short interest numbers have recently switched to calculate percent of float rather than percent of existing shares, muddying the waters conveniently for big shorts. FINRA data shows that no matter how much those who shorted GME in January say they got out of their short positions, the FTDs indicate that there are likely still far more counterfeit shares than real ones, all produced by naked shorting and hidden by quasi-legal market manipulation via ETF sales, dark pool exchanges, and synthetic calls/married puts. Also see here. Every day the price goes down and selling volume does not seem to cause this. This is likely due to further shorting, and an attempt to kick the can down the road, discourage talk of a short squeeze, and dig the short sellers deeper in the hole. The amount of cash needed to do this is beyond massive, making it likely that the huge negative beta is because a major market player is about to be liquidated because for shorting beyond belief to get out of being short squeezed in GME, and likely did not succeed. For more on everything, GME MOIS FAQ. Edit: I don't have the karma to post on Superstonk. Be my guest. Disclaimers. This is not financial advice and I am not a financial advisor. I'm just a tanuki that eats crayons and likes to bullshite about stonkies and crazy stuff for funsies and to take voyages to the moon and beyond. Not a financial advisor, not financial advice, just a crazy tanuki that likes moon voyages.